Welcome to the Broken Pie Chart Podcast, episode 253, final one for 2023. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, how you doing today? Big show.
What a year. Like, how about a wow, right? Like, what a great year for the markets, I would say.
Yes. I mean, I feel like this is the most hated good year that I've seen. I don't know if you feel the same way. I mean, it's 31 years now in markets.
I don't know. I think everybody feels like, wow, this is great. I think it's the most surprising, market. Maybe the pandemic year was a little more surprising to close up where it did. But I don't know. I feel like everyone's like scratching their head like, okay, we'll take a plus 20, a plus, what did the NASDAQ close? Like plus 40%, 43%. Okay, well, I guess we'll take it. I mean, that's what it feels like. Like there's some disbelief, but I don't feel the hate for it. I don't feel the anger that the market's got it wrong. I just feel everybody's accepting it and going, well, could be worse. I guess that's how it feels. So,
yeah, and
I don't know.
Maybe I don't want to say people are upset, but like they're not reacting the same way. Maybe it goes back to inflation. Because I think the thing, and I've said this before, and inflation, when inflation comes down, it doesn't mean that all the prices go back to 2019 prices. It means the rate of change slows, meaning, if we get back to 2% or, we're like 3.1% right now, whatever we are through November, those price increases have slowed, but prices are still up quite a bit. I mean, I think groceries are up like 20 or 25% or 30%. I don't even know from what they were. So maybe that's part of it, where just prices are a lot higher. So the market's up, but everyone's like, yeah, but it cost me like $1 million to buy a Jersey Mike sub now, something like that. I don't know.
Well, it'll cost you, $1 million plus next year with inflation, right? Like that's the thing. When inflation's slowing, you're still paying more than you paid last year. That's kind of the whole concept, right? So, I do think that there are some things you like. Look, it's not like everything goes up 3% when inflation is 3%, right? It's the aggregate. So there's some things that are less than last year and will be less next year, but on aggregate, things will cost more next year than they did this year, which cost more than they did last year.
Yeah. Well, thinking about just how people feel about the markets, Charlie Bilello had a chart out on Twitter, and it was the performance of the S&P 500 this year. Is this year? No, from September through probably the close yesterday, somewhere around there.
Just this quarter.
Oh, yeah. Yeah, something like that. So anyway, he's got a chart. It's an interesting chart. It's the S&P level against the NAAIM Active Manager Equity Exposure percent. So I'm going to guess National Association something, I don't know, whatever the group represents. But yesterday, 103% was the percent of exposure to equities, meaning you've actually got a little bit of leverage. It's greater than 100%. And the thing, I mean, the audience can't see this chart, but if you look at the lows in October, the percent exposure to equities, God, it looks like it got down less than 30% exposure. And like no surprise here, but it just shows you active managers, equity exposure, they had the least equity exposure at the lows. And now at the year highs, it's like, it's just patented, right? They have the most equity exposure. Like you could have bought the market when it was lower and then had a lot of equity exposure. No. We'll just keep, we'll buy, and as it makes a high, then we'll high for our equity exposure. Like just sentiment. It's so transparent the way people invest, right?
Yeah, and look, I would say it seems like the obvious response is, "Oh, good job having lowest equity when markets are down and the highest equity when markets are up. You're chasing," but I don't. There's two questions. One, I don't know if it's because the market's going up that their equity percentage increased. Probably not. That means they're reallocating towards it, right? If you're going to take your allocation from, I think it was like 25% equity up to 103% equity. By the way, this is a little bit of a chart crime because the
Uh-oh.
axes don't
Throwing the
match. But
flag.
yep, I throw a little flag. But look, they're absolutely correlated. The other thing when I you always say, like, oh, good job. You're buying the market at the high. It was okay too. It was right to be buying, to adding equity exposure in November, right? So as you look at this chart, they're adding through November while the market is going up. So, I think the market could continue to go up, and their leverage will probably help them outpace it a little bit if the market keeps going up, right, in the first place. But yeah, it's the irony is, the sentimental chase of the market, had them kind of under allocated at the time they should have been over allocated to equities. Yeah, you're right. Bad timing.
It's
Good job
also, I mean,
chasing.
I know. I mean, but also, I mean, you think about everyone's sentiment in October. There were a lot of people, and this is part of what I mean. We have strategies, and financial advisors and institutions use our strategies, and we have conversations all the time. And we know and we have individual clients, and the tendency is to say, well, the markets are selling off, get me out, go to cash. And sometimes the right thing to do is do less, do nothing. Just, be, as we would say, be hedged, but be in the markets. So, but investor psychology and sentiment gets in the way, and that as investors sort of maybe panic a little bit, it bleeds into the institutional side. But I think institutions, I mean, we'll get to our 2024 predictions and review how we did in 2023. You did a little better than I did, hint there. But yeah, I mean, it's where the market is sort of really guides people, what they want to do. All right, let me save that for the discussion later. But Jay, the other thing I wanted to point out is, earnings this year are, I mean, we don't know the final earnings, but flattish, I would say. And ticker TKER on Twitter had put out a post from Janice, and it's the S&P annual earnings change versus price change. So think about this. We'll probably wind up about 24% total return this year, give or take. I haven't done the math on it on the S&P, but earnings will be, pretty much zero. So, and the chart that they're showing, Jay, is there's not a lot of correlation between the change year over year in S&P earnings and the change in the index. Like the R squared, for those of you who know statistics, was 0.02. And I'll just clean that up and make it easy for everyone. There's not a lot of correlation, right? So
Yeah, it's just a splattering of dots, on this chart without any real linear correlation or the ability to kind of, use earnings to project what the S&P is going to do. It's all over the place. And I think it's because the market doesn't trade at the times the earnings come out. We always talk about this, right? We always talk about that the earnings changes is typically led by the market, and then you find out the data later, right? So I'm not surprised, Eric, that you've got these two data points that over the long term have some correlation, I would imagine, but in the the 1 year time frame, if one of them is going to be 6 months ahead of the other, this is going to look like a random dots on a chart. There's no real leading trend to glean from this.
we also know there's a chart by Goldman Sachs that looks at the index price and earnings per share during U.S. bear markets. And this is since 1903. And what you see is that markets tend to turn prior to earnings getting to a low. And I think we saw that this year too. I mean, the earnings, we saw markets start to go up as earnings were having, a little bit of a negative year over year returns. So yeah, no surprise there. The market's forward, and we see the market will reach a bottom before earnings reach a bottom, and typically before the economy reaches a bottom. So no surprise there, right?
No, it's exactly what I was talking about, right? Where the market bottoms 6 to 9 months before the earnings bottom out. And so if we're flat, Derek, right, but the market is going up, right? Being interesting to see, flat on earnings. So the market is projecting earnings growth. I mean, that's one way to interpret that. And if it's going to be kind of 6 months ahead, yeah, I mean, it should be, unless the market was really jumping ahead. Like in the past, let's think about the way we finished 2021, right? Felt a little like the way we finished this year, right? That last month, the market just kept going up, up, up in the month of December. So it's one of those things that, I don't know exactly what to take from it, but the market is certainly, optimistic at this point, regardless of what earnings, are actually going to post.
You mentioned 2022, and I was feeling good about my next year's going to be an up year until you said that. Am I making the same mistake? Well, here's the thing. Well, all right,
Yeah.
no surprise here. This is from BMO Capital Markets, and they've got a chart, and it's the headline is "Great years follow horrible years." I think Sam Rowe had this on Twitter, so I got that from him. But it's from BMO, and it says in the past 90 years, the S&P has only seen a more severe loss than 2022 four times. And the point is, they show like 1937, 74, 02, 08, and then the average. And the point is the calendar year price change and then next year's price change. And on average, when you lose 32.5%, the next year you gain 26.5%. As you said, like, where was this data last year when we were making our predictions? This one,
Yeah, thanks,
it's
BMO.
like,
Where was this information last year after we were down whatever 20%? Would have been nice to know that the average rebound is over 20%, which turned out to happen. Thanks,
yeah,
BMO.
like
Where's their
no
prediction?
surprise. Yeah,
Can we go
we're going
back
to
a
write a
few
letter to BMO.
podcasts? Can we go back a few podcasts and see where they are predicting this year to go after? Because now I want to know. But okay, I know you don't
Yeah,
have it, Dan.
but in hindsight, it's like if you take away, and this is my point about the investor sentiment and what you feel like in the time based upon how everyone's reacting, what everyone's saying on CNBC. And honestly, we've been on CNBC, you've been on CNBC a number of times. I'm not sure individual investors are really helped watching it. They'd be better off just buying, hedging, and like watching the game show over the year. But
Well, plus
yeah,
the programming is kind of dictated too. It's interesting to watch that, right? When things are bad, all they do is bring on people that talk about how bad things are going to keep going. When things are
yep,
good, all they bring on are the bulls, right? So maybe every once in a while you get the bear coming on in a
yeah,
bull market, but generally they lean towards more of the same. Like, right, the crowd think and the emotional consistency, yeah, it's I'm with you, Derek. It's why you have to make your own decisions, and it's why it's guessing which direction the market is going to go is really, really hard.
yeah. Well, but anyway, back to this chart. Apparently, when you have a down year, you should expect an up year. And I think that's,
Oh,
as you and I
imagine.
say, most times the market is up. We talked about that last show where surprisingly, the market's up between 15 and 30% more times than you would think. And we know that even though the average is sort of the average, the market doesn't get the average that often. But here's another thing. Maybe this will help us with our predictions, Jay, for 2024. This is from, who's this from? Carson and FactSet. It says a big final 2 months of the year is quite bullish for the next year. S&P 500 returns after a 10% gain in November and December. Now, this doesn't include today, probably. I'm not sure when this clipped the return, but apparently 2023, November, December return, 14.2% in just November and December. Think about that. You'd be happy, or most people will be happy with 14.2% for the year. So here's the thing. What they've done is they say the average, when you have greater than 10% in November and December, for January is up 2.4%, Q1 up 6.6%, and the next year to be up about 19.5%. The medians aren't too far, beyond that. Okay, so and the average, the average, taking all the years since 1950, is about 9.1. So okay, good November, December, Jay. Going to be a good 2024? Question mark? Question mark?
I mean, I guess this tells us that when you have these double-digit gains in, the last 2 months of the year, looks like it kind of continues through into the next year. Based on this, I want to change my prediction, Derek. I came in much lighter than this for next year, but I am also not forgetting 2021 to 2022. But
yeah,
there was a
this
different
is.
underlying scenario.
I know. I'd have to. I didn't go back and see what my 2022 predictions were. I know they were wrong, but I feel
They
like when we
certainly
did
weren't
ours.
20% down.
No. So, all
You and
right,
I were
let's
close to
get
like the +5 mark, I think.
probably.
I mean,
Yeah.
close to each other, not close to being right. We
No,
were
no,
way
no.
off.
Well, let's talk about that. So, you and I did some predictions last year. We did a prediction show, and I will tell the audience last year I did better. This year, 2023, Jay, you did better. So, let me just go through some of these briefly. Jay, you predicted, and remember, we did these in December of 22, the kind of this time of the year. You said the S&P this year at the end of the year would be 4350. You were more right than I was. I said 3999, so basically 4,000. And then we'll be close today, like 47, 69, 70 or something like that. Basically just under
Yeah,
49.
4770. Yep.
Yeah. So 4770. So, okay. Yep. We were not correct there. We were not correct.
Both light.
Yeah. But, and what we, I don't remember. So, what we should have done for this year is we should put what our 2025 EPS estimate is. You said, by the way, earnings would be 240. I said they would be, what did I say? 215. They'll probably come in around 219, 220. So close.
You're closer than me on that one. Yeah.
Yeah. So we were definitely wrong there. Where you got it right, it looks like you said a GDP change of plus 5%. And GDP won't be final until, we're not going to get Q4 GDP until the first estimate at the end of January. But you said 5%. If I calculate back of the envelope with the Atlanta Fed GDP, estimate right now, I mean, GDP is probably going to be around a little north of 4% for the year if those numbers are right. So you were more right than I was. I said 1.8%. So
I remember
you're the
you
savant.
giving me a little grief about that number.
I certainly did. Did. And inflation, looks like I got this one. I said 3.05%. Through November, year to date, it's 2.99. You said 5%. So
you're definitely
Fed
closer
funds,
on that one. Yeah.
Yeah, Fed funds, you said, let's see, end of year, 5 to 5.25. We're 5.25 to 5.5. I was 4.75 to 5. So we were both pretty close, but you were closer than me. And what else do we? I don't know. Let me see here. Year-end 10-year Treasury yield. You had 3.5. We're 3.8 right now. What did I say? I said 2.95. So, yeah, we were not correct. I will say, one of our traders, Brett, on the market prediction, he had 4,800. So he was within maybe an extra day in the year, and he might have gotten there.
He might have got it. So, yeah, he was very, very close to be up by just 30 points there. Less than 1%. We did have one trader that thought we were going to 6,000. I think he may rethink that for next year. Yeah.
Or
you never know. He is the perma bull.
He is a perma bull. That's Mick. He's he may go put down like 8,000 or something like that. We'll see where he comes in.
That's good.
Here's an interesting one too. So oil will close the year probably just south of 72, West Texas Intermediate crude. You had 75, so you were awfully close. What did I have? I said 80. So yeah, you kind of
not that much different. Considering what we went through last year, right, with oil kind of really spiking after the Ukraine conflict started. War. It's
Yep.
war. It's not a conflict. It's a war.
Yeah. You also said yes for a recession, as did I. We were wrong there. Well,
by the way, I want to call that out, right? How many times have we said on this podcast, like, oh, everybody said recession and they're all wrong? We also said recession. I guess I should point that out.
But this is what I'm saying. When we have 29 out of 30 economists saying we're going to be in a recession, like that impacts your thinking. So,
yeah.
You know. All right. Anything else we want to cover?
Recession for next year. Oh, but I don't want to jump ahead yet. Go ahead.
All right. No. Anything else we want to cover? I mean,
well, I mean, I think the one that's as options guys, right? The VIX is always interesting to us, right? Like, where did the VIX peak out for the year?
And so the intraday high was 30.81, if my notes are right. It closed, though. The high close was 26.52. So
it's not a scary year to have only like the intraday high be 30.8. Like, not a lot of fear came in. And that happened obviously during the banking crisis. I was going to say conflict. The banking crisis, in March, right? So, besides that, there wasn't a ton of fear in the market this year.
It really wasn't. I mean, you had 35 for the high. I had 33. I mean, then we had some sense on the end of it, but I mean, to have an intraday high of just north of 30. No, you're right. I mean, usually when we see a spike in the VIX, you'll see that one day where it gets above 40 and is really scary. But no, nothing. And we ended the year, with a 12 handle, right? So
I the thing, Derek, I will remind you of a data point you and I have talked about now for decades, literally, which is when the VIX closes above 30, it tends to stay above for another month. Right? You remember that data point we've talked about in the past? And this year, even touching above but not closing, it never got back there. Like, sometimes the numbers just kind of work out that way. So, we also talk about when the VIX closes below 13, right, that it stays, below 20 for at least a month, which has absolutely just happened. But yeah, I don't know. Like, volatility is always the thing that we watch, right? Option prices is obviously really interesting. But despite all of the written fear, people talking about it, the chatter, actually the market never really behaved in a fearful way.
It didn't. It really didn't. And remember the drawdown we had, what was it, October? I mean, that was a pretty healthy drawdown. I mean, I don't know if we got to 10%.
We corrected, right? It was a correction.
But then
market never got scared. I wonder if it's, in hindsight, right? I think a lot of folks are using some very safe instruments, like as treasuries became interesting again. And you're not so scared when your money's in treasuries, right? You're less reactive, right? Mm-hmm. Less likely to make an emotional decision when you're kind of locked up. So I don't know. Could be some of that too, right? Just you see the balances in bond funds exploding. So.
Well, I also saw, money markets are expanding, but here's my thing. I think that as a gauge isn't the best. It's not a clean data point. And here's why. It's easy to say, like back in time when you could get 5% in your checking account, or you'd say, okay, are people really coming out of equities and just putting money in money market funds or brokerage firms? That was a better gauge. But now when Wells Fargo or JP Morgan Chase or Bank of America are offering the fantastic rate of 0.05% on your money or whatever the heck they're giving you right now. I think a lot of money came out of banks, went into brokerage firms, into money markets. That was really bank money. So I don't think that was necessarily money that was coming out of equities and going into money markets like it normally is. So
nope. Yeah.
That's kind of one of those things too. All right, so 2024, I don't have anything else to say about 23 except the more we do this, the more predictions are sort of difficult.
Not your favorite one? Your favorite one on this list? You don't want to reference Bitcoin end of year price?
Fine. We did have one trader say, "Who cares?" was his prediction.
Yeah, it was you. Who said who?
No,
cares?
It wasn't me. I said 20. Did I say 20,000? I was awfully
wrong. You said 7,999.
Oh, did I? Was I that low? Okay.
You wrote 8,000 for Bitcoin. It was the guy that Brett who nailed the S&P said, "Who cares about Bitcoin?"
That's right. A protest vote.
Yeah.
I did. I said Bitcoin would be 8,000. It closed today, north of 42,000. So, yeah, I mean, you were closest. Somebody else had 70,000. So, you were like 15,000, 17,000 off. You said 25. Somebody had 70,
Yeah.
but
Nobody got that one right. Nobody. Yeah.
it's
Previous
a hard
high.
one. It's a hard one to get right. I still, well, anyway, don't get me started on crypto. Let's go to 2024 and let's start here. Let's go with the S&P 500, Jay. What do you think the S&P 500, the closing value this time next year is going to be for the S&P and why?
I'm at a 5,200, which
Oh,
is, it's certainly not, 20% like the final 2 month data would show us. But yep, I'm at 5,200, moderate gains. I think this year got a little ahead of itself. But I still see growth, right? Even if we have, the dreaded prediction here, I don't think the Fed cuts rates, and we'll talk about that in a minute. So I think the market all the anticipation of that was preloaded, right? So I think it's all I should say front loaded. So that's why I'm at the 5,200. Where were you?
I mean,
Where
you
are you
really
at the
went
end of
out
the
on a
year?
limb here. You're up since 1950. You're basically the average. You're saying 9% is going to be the gain from the end of this year, right?
I
So,
mean, why not go average? I got a 50 delta, I feel.
but I just told you that the very often, very few times, the market actually gets the average. Normally to get to the average, you have a lot of years above it, some years below it. But yeah, no, I get it. I get it. By the way, we should start putting what we think are 2025 forward earnings consensus will be from analysts because, like right now, there's a consensus prediction for 2024 and the market trades on the forward valuations. So, but let's say the market, if the consensus right now is somewhere between 270 to 275 or 25, that means the end of 2024, if you think the market's going to be at 5,200 and let's say you get, 275 is the EPS estimate for 25, you'd say the market's trading at an 18.9 multiple. So no, it's not. I mean, that's a higher than normal multiple. It's lower than it is
I
right
got no
now.
problems predicting this year's earnings, let alone 2025 end of year earnings. But of
I
course, that is
mean,
what next year's closing price will be based off of. But yep,
yeah.
I'm
Okay.
go
So
ahead. So
I'm
where are
I'm a
you?
plus 15. Yeah, I'm a plus 15%. I got excited last week when we saw the market a lot of times is between 15 and
Yeah,
30% up. So
half the
I'm 50.
time the market is up more than 15%. So,
Yeah.
you're going
I'm
with that. You
I'm
really have the
going
50 delta.
yeah, I'm going to 5,500 is my end of year. And 5,500 if 275 is the forward estimate at the end of next year, I'm at a 20 multiple. So and this goes to show you that the difference between you and I's prediction is basically 20 multiple versus an 18.9 multiple. It's 1.1 multiple points, and that's a difference of 300 S&P points. Like this is how hard this is. You basically picking a forward multiple, right?
Not everybody puts, that much stock into the multiple, but it is a big driver of how earnings are interpreted when it comes to stock prices. But I don't think 5,500 is a bad number, Derek. I mean, I don't think it's bad. I actually picked that as my high for the year. I just don't think we end there.
Yeah, I was going to say that. I mean, you had 5,500 for the high. I have 5,500 for the close. My high is 5,600. So it seems like maybe I need to rethink that. But it seems like we're going to go up there towards the end of the year and then slide back down right at the end. My low is 4,500. You had a low of 4,100. So That's a pretty healthy correction, Jay. So 4,100 divided by
Yeah, well, look, we got
4770.
some gaps to close down there, right? Like if you're a person that follows technical analysis and watches gaps, there's some gaps down there where we rocketed through those and have a lot of ground that was yet to be covered. We skipped, and if you're someone who watches gaps, all gaps get closed. I don't know when it's going to happen, but we will see 4,100 again if the gap theory is correct.
That would be about a 14% drawdown. And by the way, there's plenty of years when you have 14% drawdowns and you finish the year up 20%. I mean, it's just I don't have the chart handy,
Sure.
but there's the
we just had one, 2020.
Yep, for sure. So, all right, let's talk about the VIX. We're going to be boring here on the VIX. My high
gosh, look at that.
Was 35.5. What was yours? 35.01.
Same as this here, 35.01. That's my number.
We're kind of boring. Here's the thing with the VIX. It's a little easier than the markets because we know the VIX is a mean reverting. Like the VIX isn't going to go to 1,000. If that happened, that's a whole nother story. I mean, it's sort of so.
It's not going to 1,000. Yes.
Yeah, like to me, I felt like, and maybe you felt this way too. VIX is low right now, so a spike to 35 would be a significant jump. We're in a low volatility regime. Sometimes when you're in low volatility, you stay in that regime. I don't know. I mean, it seemed like a good number.
Listen, if we're going to get to 4,100, I'm going to need a VIX at 35.
Yes, I would say that. Well, I have a low of 4,500, which is whatever that means. There'll be. Here's the thing, though.
You don't even have a 10% in there for us, huh? Not even a 10% correction after this run we just had.
Apparently not. Well, no. It doesn't. We could go to 6,000 and come back to 4,500.
Oh, that's well. You said the high was 56. You're right. Well, look, I'm just saying. I know the numbers are here. You don't have a lot of fear built in. I don't know how we're getting you at 35.
My thought is we're going to have some volatility. This is I'm so lazy even saying this, but there'll be some volatility into the, at some point due to the elections. And once the elections get resolved, then we have that end of the year kind of, because who knows? All right. So EPS for 24, I had 243. Basically, what is that? That's 11% earnings growth rate. You went to 250, Jay. Any thoughts on why you're there, or seem like a good place to be?
I think a little contraction. I think earnings are I still think, decently strong economy, but I think maybe a little contraction in the multiple. Whereas I'm looking at yours, right? It ends up being, just a little less aggressive here. But yeah, no, I think we get decent amount of growth. Your growth in the market matches your growth in earnings, right? They're fairly close.
Yep.
I think a little contraction over the skis. That's my point.
So the fact that you and I both have up years means we'll be down like 5% or something like that next year. Yeah, watch.
You should.
All right, you kind of teased it a little bit. We do hedge, Jay. That's why we hedge.
Oh, hey, that's a good idea.
Yeah, we buy and hedge. Good book, by the way. What a nice book to pick up this weekend if you need a last minute New Year's gift. Maybe
if you get that, you got to get the broken pie chart, right?
I don't see why not.
Get them together.
Both books. At some point we'll figure out how to do where if you bought this, you should buy that. I don't think our books are quite linked there. All right, Jay.
We'll figure it out.
This is a contrarian. I want to get to the Fed funds. So everyone says now that I think consensus is 100 basis points of cutting. If the Fed actually cut 100 basis points, they would go from 5.25, 5.5 down to 4.25, 4.5. Jay, you said end of year Fed funds is exactly what it's going to be. No cut next year, huh?
End of year? I thought I had one cut in there. 25 bips. No.
Oh, you do have one cut. Sorry. Okay. One cut.
I put one for optics. They're going to do one for optics. And I think they're not really incented to do it. Maybe, towards the third quarter. Like, I don't know the reason why they would cut.
Yeah, I mean, so I'll just give you mine. I think they do 50 basis points, 4.75, 5. But I don't know. Do you have any? We didn't do this in the predictions, but when do you think they'll do the quarter point? Is it early or is it late?
No, it's late. It's late. I think
Yeah.
we got to get through the first half, and then I don't think there's any rush. I mean, they're just thinking about. They're talking about thinking about it at this point, right? Is that like whatever their phase is? Oh, we should think about it, but they're not thinking about it yet. Nope, not till the second half of the year.
Feel like there's some precedent about the Fed doing rate cuts and stuff around elections. I should have checked that before we started recording, but yeah, I think like I almost like your prediction more because I think the consensus, I mean, it's just overwhelming consensus they have to cut. But I go back and say if there's no problem in the market and they don't, just because inflation gets down, the rate of change gets down lower, and we'll get to that in a second, they don't have to cut. Like they don't want to cut if they don't have to. Here's the reason why they cut though. And I've been thinking about this a lot. I don't think they care about the commercial, not the residential real estate market. It's not that they don't care, but I still wonder with bank balance sheets and the commercial side whether the Fed is going to have to do something to try and help those areas out. And that would be like if you ask me like why would they cut, I would say they cut because of those reasons. Maybe I'm wrong though.
Maybe. I was thinking if there was a reason they cut is they just are so far above where CPI is, right? They're so far above inflation. Maybe they just feel like, hey, we could bring it down, right? People shouldn't have a real rate, like a real rate of 2%, 2.5% is historically a little high. But I think they'll wait to see if we get a little choppiness, in the markets first.
Yeah, maybe. I don't know. All right. So you have 5.25. I have 4.75, 5. And I'm looking at our end of year 10-year Treasury interest rate or rate prediction. So both of our predictions, I'll let you start. Oh no, you have basically your yield curve is flat. Yeah, tell me about your 10-year.
I have the yield curve flattening with the 10-year rising to approach to the level of Fed funds rate, which that is not the way we're ending this year, right? Fed 10 years been dropping along with everything else. Well, Fed funds hasn't changed, right? So this is definitely, I thought I'd get a different one on you here, Derek, but I guess not, right? So I see 10-year ending at 5%, which would be bearish for the 10-year bond, right? To go from where do we close today? 3.8 to go, I think that's where it is, right? High threes to a 5 is bad for bonds. But you're even worse.
Yeah, I mean, I have the rate expanding and ending the year at 5.4. And my thought is that the yield curve uninverts. You've got it basically flat. But if I'm saying that there's no recession, at some point the 10-year should have the anticipated nominal GDP growth rate in it. And it's not, you can't stay inverted forever, but maybe we can. So yeah, I have it going to 5.4. I probably, we don't have the 30-year on here. I could see the 30-year getting to 5.75. I mean, it should be higher. Like you should get paid if you buy a bond that has a longer term to maturity. You should get a time premia, as Janet Yellen would say. So yeah, my high, by the way, is 5.5. So again, I have everything happening at the end of the year, apparently. You had 5.25, but tell me about, you think it's going to drop a little bit more. You have a lower low than me here.
Well, I don't, I just think that's where we kind of lead too early, right? That's not a late number, right? I think we're trending towards that in the short term.
Yeah, you're 3.5, I'm 3.75. I mean, basically, I think the consensus is for many more rate cuts than you and I believe. And so we're going to see the 10-year maybe trend lower a little bit. It's also, what do you have for GDP growth for 24?
Looking on the sheet, I got to move over here. So I come in with light this time. I come in at 1.5 on GDP, right? Again, I think it was front loaded this year, slowing down next year.
Yeah, I'm
Still
two and a
growth.
half. I'm boring, by the way. I'm probably like the average for however many years. I probably could have been a little bit lower. So, but the reason I go to GDP is you say, okay, well, 1.5, if you're 1.5 on GDP and you've got a 3.5% low on the 10-year, that sort of makes sense, because for GDP to get to 1.5, it's going to have to disappoint at some point,
Yeah.
So
Right.
that seems to be been inflation. I have 3.25. I basically have the same thing I did for this year, and you've got 2.5%. I don't know. I mean, I nailed it last year. I think, why not go right around the same number? But, CPI includes oil, and we'll get to oil in a second. But, I have oil going higher next year. And if oil goes higher, my thought is we're not going to get into the twos at all, because oil is a big part of CPI.
Yeah. Well, I'm looking here. Where was I on oil? No, you were higher on oil.
What'd you have? Are you at 70?
I had
Yeah.
70. I have more of a drop. You have more of an increase. There we go.
Yeah. So, okay. So maybe that's the difference. I have oil going a little bit higher.
Okay. Well, what else we got? Let's get this home here. I like your gold number better than mine, right? So you have a little higher inflation, right? So you're coming in gold at 2,100. I'm at 1,900. Um, what do you think? Related to your inflation number? Is that it?
I don't know. I nailed it this year. So
Got it.
gold is going to be unchanged, whatever.
You got your dollar index a little lower, so that's consistent with higher gold, right? It takes more dollars to buy gold than the dollar index, and my dollar index is a little higher. So you're a little lower on the dollar. We're both lower than where it is now, though, which could be bullish for equities, right? That kind of lines up with equities going up. But the best one, Derek.
Come on.
You got Bitcoin at 20,000. I got it at 65. I say, we get to new highs, but look, that one is just as random as anything else on this list, in my opinion.
I mean, so look, I mean, my opinion on, the audience knows my opinion. My opinion on Bitcoin. I'm not a fan. I don't understand how it has any value. And I think most of the other coins have shown that they literally have no value. So the only reason why Bitcoin goes up is because there's more buyers than sellers. Like if you're buying that, you think you'll be able to sell it to somebody else. So
I'll tell you where I think we get some upside pressure here, right? You're going to get more regulatory opinion on Bitcoin, and what you've seen right now. I don't know if you've seen the last few months, right? There's been a nice little run up in it, and even all the stocks that are related to Bitcoin, whether it's Coinbase or MicroStrategies or Block or PayPal, right? They're all kind of leaning higher here because if all of a sudden this is kind of a weird kind of connection for everybody, but if all of a sudden the it's okay to have a spot Bitcoin product, not a Bitcoin futures product, but like an ETF or an ETN or a 30 Act product or a 40 Act product that allows you to hold Bitcoin, actual Bitcoin, like GLD holds actual gold, right? So if you get a product that's allowed to hold actual Bitcoin, you're going to have a supply demand dynamic that will push it up, because there is a limited supply of Bitcoin. So you're right, more buyers than sellers, Derek, but it's a little deeper than that, in the fact that there is a limited quantity of Bitcoin that can be bought. And it's more and more expensive to mine it. In other words, solve the algorithm. And that will push prices up if there's an actual just demand, right, to come out of some of the the Bitcoin future products or the Bitcoin trust and move to a product that holds spot Bitcoin, that will push the price up. So that has been the driver of the press higher over the last few months. Right. So a little deeper than more buyers and sellers. But look, that's one guess. We don't know what the regulatory assessment is going to be. I think we find that out early January. So we'll know shortly.
Eric Baltunas, who you were on at Bloomberg, he had tweeted out some stuff today. The S1s are coming. I think Valkyrie and then BlackRock have named their APs, their associated market participants, the people going to make the market and do the collateral and stuff like that, right? So those are coming. Part of in all seriousness, I mean, I almost put just zero because that's what I think it should be worth. But in all seriousness, like sometimes I think this price run up might be people front running it, believing that once the ETFs come and the demand will come, that the price will go higher. So it's just like when Tesla was going to go into the S&P 500, or a lot of people really bought up Tesla, and it's buy the rumor, sell the news type of thing. So maybe there's some disappointment as these products come online and all the buying happened. But I don't know. I just don't have a sense for it. We'll see what happens. I know apparently Bitcoin supply is supposed to be fixed, but I do remember in the 90s or the 80s, one of those baseball card companies, they actually were printing up. It's like printing money, but it was a documentary. They printed up additional like rookie cards because they could then sell it on the secondary market. They got caught doing it. I forget what company it was. So like, I wouldn't be surprised if more Bitcoin comes in, but that's just me,
From where? I would be surprised. I would be surprised. You can't just print more Bitcoin.
Why not? You can do whatever you want. Print more.
I mean, that's the whole point of Bitcoin, right? There's one of the points of Bitcoin is a fundamental. Now, look, you could have like a fork where you split off, like how they split off like Bitcoin Cash and that kind of stuff. Fine, but there's only so much.
That's what I'm saying. I don't know what that is, but I like it.
That's exactly what you're saying.
There's going to be more forks. There's going to be more supply.
I'm getting hungry here. It's talking about forks. It's getting to be dinner time.
All right. Well, we'll see how wrong we are this year, next year at this time. So anything, we talked about Christmas movies last week, any sort of recommendation stuff? I know it's been a busy week. It feels like it was supposed to be a slow week, but it's been a busy week.
Okay. Look, I have to first give you some props here because I sent you a link shortly after we recorded last week's podcast about how a CNN reporter made a very strong case as to why Die Hard is a Christmas movie. And, he made some good points, right? It's about family. It's about getting together, overcome adversity, being together at the end of it all. I'm still not sure if it really is, but you have some journalists on your side, Derek, with Die Hard as a Christmas movie.
I did like in there, and thanks for sending me that link. The reporter or whoever was on there, they're a media reporter, so they've got some knowledge. One of the things they pointed out was Holly Gennaro,
I'm already going to disagree with your point, but go ahead.
No, but Holly Gennaro, the name Holly, which is
no.
like Christmas Holly, was actually changed from the source material. So I guess her name was Stephanie or something like that in the book.
Oh, but they made Holly. It Holly.
Yeah, Christmas Holly. There you go. So, all right.
There you go. Okay.
Any recommendations? I have one this week.
Okay, so I started watching a show on Netflix called Bodies. It seems kind of interesting. I'm 3 episodes in. I'm not sure if I'm going to finish it, but it seems interesting. It's kind of like a murder mystery sci-fi that happens in 4 different timelines. And they haven't connected all the dots for me yet. So I'm menza on that. That means I'm half and half on it. And then, I think I told you continuing to watch the Jack Reacher show on Prime. That's still pretty good.
Yeah, Bodies was actually one of our listeners, friend of the program, Michael, had sent me as well. So he thought that was.
Oh, I didn't know that. All right, Michael. There you go. It's growing on me. I'm 3 in. I'm not fully committed yet.
Okay. Mine this week is Hijack on Apple TV Plus. I think it's Plus. It's got Idris Elba as one of the leads. It's based upon, no surprise by the name, a flight that's going from Dubai to London, and it's hijacked, and then I won't give away anything there. But I thought it was pretty good, well done, and you got to the end of one episode, you wanted to see the next one. So there you go, Jay. I don't know if you've seen that yet.
No, Hijacked. Okay, I will definitely do it. Definitely check that one out.
All right. Good job, market 2023. Good on you. Good job, NASDAQ. Even the Russell kicked in. And, everything was up this year. High yield bonds were up. All the equity markets. And I got to tell you, something like TLT, what did it get down to? 80 at one point?
It was in the 80s. Yeah.
So off the lows, it's up over 20% off the lows. So that's a great example. I won't get into it too much because we're going to wrap up here, but that's a great example of people bought long duration or were recommending buying long duration early in the year. They were right, but their timing was wrong. In this case, they should have bought it when it was in the 80s. But hey, it's tough to time these things, right? So
it is. I'm not sure they're going to continue to be right, though, based on our predictions.
Well, if our predictions are right.
That's for a different podcast, isn't it?
All right, everyone. Happy New Year, and we'll talk to you next week.
Happy New Year.
Yep.
Happy New Year, Derek.
You too.